Welcome to The Explainer. Today, we're going to dig into a massive shift in the world of investing, the absolutely incredible rise of passive index funds, and, the kind of weird unintended consequences this is having on the entire market.
Albert Einstein wasn't exactly a stock market guru, but this quote, it just perfectly captures the tension at the heart of modern finance. We've spent so much energy trying to make investing super simple, but what if we accidentally made it too simple? Okay, let's get into it.
For the last couple of decades, the advice has been crystal clear, right? The smartest thing you can possibly do with your money is just put it in a low-cost fund that tracks the market, like the S&P 500, and then just forget about it. It's cheap, it's easy, and honestly, it's been incredibly effective. And boy, have people taken that advice to heart, so much so that passive funds now control more than half of the entire global stock market. This isn't some little niche strategy anymore. It literally is the market. But what happens when the simple choice becomes the default for pretty much everyone?
And that right there brings us to the core of this whole thing, the passive paradox. The very strategy that was designed to make things safer and simpler for you and me might actually be creating new, hidden risks for the market as a whole.
So you've got to ask the big question. When literally everyone is passively buying and selling all at once, driven by money flowing in and out of funds, not by how well a company is actually doing, does the market lose its ability to absorb shocks? Does it get brittle?
Okay, let's use an analogy to really get this. Think of a healthy market like a trampoline. You've got all these active investors trading based on real information, and they create elasticity. They bounce and absorb the impact of all the buying and selling. But a market dominated by passive funds, that's more like a stiff wooden board. When a big wave of money flows in or out, there are way fewer active traders to cushion the blow, so prices just wham, move way more sharply.
And look, this isn't just some abstract theory. Research suggests that the rise of passive investing has already made the market about 11% more inelastic. So the big takeaway here is that every single dollar of buying or selling now has a bigger, more jarring impact on stock prices. So what actually happens in a market that's more rigid, more inelastic? Well, the relationship between real information and just random market movements gets thrown completely out of whack. So in any market, you've basically got these two big forces at play. You have signal, which is real information about a company, its earnings, its strategy, its performance. And then you have noise, which is pretty much everything else. Temporary sentiment shifts, herd behavior, and all those mechanical flows from funds. Ideally, the signal is what should be driving prices. But here's the crazy part. Research is showing that as passive ownership of a stock goes up, the importance of that company-specific signal goes down. A pretty common increase in passive ownership is linked to a 9% drop in how much a company's fundamentals actually matter for its stock price.
And guess what fills that vacuum? Yep, noise. That same increase in passive ownership is linked to a 6% increase in the importance of random, non-fundamental price moves. The stock starts to move more just because the index moves, not because the company actually did anything.
And this isn't just academic. It has real, tangible consequences. A noisier market is just a lower quality market. We're seeing stronger price swings that then snap back, higher costs just to trade, more volatility for individual stocks, and, this is the scary one, a bigger risk of sudden extreme market crashes.
So you see, this new market structure, it doesn't just change the mechanics. It also preys on our timeless psychological biases. The very things that make us human can make us pretty terrible investors, especially in a world that's so driven by noise. First up, the classic, FOMO, the fear of missing out. When prices are being driven by these huge, noisy flows instead of fundamentals, it's just so easy to get swept up in the hype. And social media just pours gasoline on that fire, encouraging everyone to pile into the same hot stocks, usually right at the top. Now, on the flip side of that, you've got hodling. It's a term that came out of the crypto world, but man, it perfectly describes that tendency to just hold on for dear life, no matter what happens. It's fueled by our deep-seated hatred of admitting we made a mistake and taking a loss. And in a noisy market, that can be so dangerous, causing us to ignore the real, fundamental signs that, hey, maybe it's time to sell.
And really, both of these things, FOMO and hodling, they feed right into this ultimate bias, herding. Passive flows are already a kind of mechanical herding. When you throw our human psychology on top of that, you get this incredibly powerful feedback loop that can inflate massive bubbles and then accelerate crashes as everyone sprints for the exit at the exact same time.
So what does this all mean for you, the individual investor? Well, it creates some genuinely difficult dilemmas. The simple, timeless advice about investing is now just full of contradictions.
I mean, think about this classic problem. We're always told to be patient and ride out the storms. But at the same time, we have to know when to change our mind because the facts have permanently changed. In a world where a stock's price can be totally detached from its fundamentals, how on earth are you supposed to tell the difference between a temporary downturn and the actual beginning of the end?
Or how about this one? The line between being a smart contrarian and just being a destructive cynic is razor thin. It's so tempting to bet against the herd, but here's the thing. The herd isn't always wrong, and blindly fighting the massive flows of today's market is just a recipe for disaster. The real trick is knowing when the crowd has truly lost its mind.
So where does all this leave us? Well, it means we really need to stop searching for one perfect, simple strategy. Instead, we need to develop a whole new awareness of the environment we're actually investing in. The game hasn't been solved. The rules have just changed.
So look, if you take one thing away from this, let it be this. The new edge in investing isn't some secret formula. It's awareness. It's about asking totally different questions. Instead of just asking, is this a good company? You now also have to ask, how is this stock being pushed around by these massive index flows? And is this price move driven by real substance or just by hype? That's the new layer of complexity we all have to deal with.
But you know what? This new reality, it actually creates opportunities. Active investors are now hunting for the weird dislocations caused by these passive waves. For instance, strategies like mean reversion are basically designed to exploit the very noise we've been talking about. When a stock price gets pushed way too far from its historical average by these non-fundamental flows, some traders will bet on it eventually snapping back. It's a whole new game. In all of this, it really brings us to one final critical question. The simple promise of passive investing has created this complex, chaotic, and pretty fascinating new market. In this world, dominated by algorithms on one side and raw human emotion on the other, maybe the biggest risk isn't picking the wrong stock. Maybe it's not understanding the forces that are moving that stock, and even more importantly, not understanding the biases and emotions that are moving you. So, in a market driven by code and crowds, is the ultimate advantage simply knowing yourself?